The biggest mistake that investors make, in my opinion, is trying to schedule or time their purchases based on how you anticipate the economy will do over the following year or two. They claim that although there is confusion now, there was uncertainty on September 10, 2001, people just weren't aware of it. Every day is uncertain, so accept it as a part of investing in any way. On the other hand, uncertainty can also be your friend. For example, when people are worried, they pay us for things, and we attempt to price them, but we don't try to time them at all. If I buy a farm nearby, and the year turns out to be bad and pests invade, there isn't any rain, and things like that happen. When I know that over the course of the next 100 years, there will be 90 years that are fairly good and a few bad ones, am I going to sell it for half the amount, which it was selling for a year earlier? Attempting to time events in that manner is simply absurd, and nobody is ever able to predict what will occur tomorrow. The only issue is that occasionally, especially when other nearby individuals get anxious or fearful, they become even more worried about it. Nevertheless, during the past 18 months, a lot of issues in the economy have been resolved, and confidence is beginning to return. There will be 4.5 million homes built or sold this year, and many of the harmful acids are in better form than ever. Roughly 80 million residences exist in the nation, and 25 million of them are mortgage-free. In many cases, buyers of the 4.5 million sold homes make decent down payments and can handle the cost of the purchase better with their income. As a result, a large portion of the market for liar loans has vanished. Therefore, those homes are passing into stronger hands every day, and by the end of the year, 4.5 million homes will be in better hands than they were at the beginning of the year. The system is purging itself, but it takes longer than a day, a week, a month, or perhaps a year to finish. Most common mistakes people make in investing, they simply aren't aware that all you need to do is purchase a cross-section of America and then never listen, read the news, or take any other action after that. They believe that since you can trade, you should do so because you can't sell an apartment or a farm you acquired today and you are aware of the expense of moving sooner. As opposed to other types of investment activity, you now receive something provided to you that is instantaneous in the sell and costs pennies. They do move about because it is so easy for them to do so, but moving around is not more wise than investing. If you owned a good farm and had a decent tenant running it, you wouldn't sell it because someone said, "Here's a new article, this really is happening in Greece," or anything. Nor would the concept that the European news would slow down in this or that or anything similar drive you to do so. If you had excellent management, a well-located apartment building, with the ability to slightly increase your rents, you wouldn't think about selling it. If you directly owned a successful business, such as the neighborhood McDonald's franchise, you wouldn't always be considering purchasing or selling it. Now that you own stocks, you also own fantastic businesses that you may choose from when it comes to the best companies in the world. The idea that news events should prompt you to try and jump in and out of something that is a fantastic game is a terrible error. You are in a wonderful business. You have people running it for you, and you know you're going to perform well over 5 or 10 years. I should have held onto that stock forever, and I've been investing in stocks ever since. I bought my first stock at the age of 11 years old, roughly 3 months after Pearl Harbor, while Corregidor was falling and there was the death march going, and all the news was terrible. It was an excellent time to buy stocks, and I should have held on to that stock forever. Let me know in the comments if you have any other questions about investing. Let's return to the video. Yes, I have made a lot of mistakes. However, purchasing Berkshire Hathaway was one of my biggest blunders because it was a terrible textile company that I had purchased for a very low price. Ben Graham taught me to buy goods quantitatively and to shop about for deals. This lesson, which I believe he gave me in 1949 or 1950, left a lasting impression on me. So I started searching for what I like to refer to as cigar bunches of stocks. The cigar butt method of stock investing is searching the area for cigar butts while strolling down the street. You eventually come across a truly awful-looking cigar that's wet and ugly and has only one puff left. But you pick it up anyhow because it's free, or at least inexpensive. After that, you start searching for another stale, one-puff cigarette. I made the same mistake for years. Even while you make money doing it, you can't do it with a lot of money. It's far simpler to simply purchase fantastic firms. Since Berkshire was selling below its working capital, you could get the plants for free, the machinery for free, the inventory and receivables of the discount, and more. As a result, today I would rather buy an amazing business at a reasonable price than a fair business at a high price. But back then, I was buying cheap stocks, so I bought it. I continued to run a poor firm 20 years later, and the money did not compound. You definitely want to be in a successful company because time is that company's friend, because it keeps growing, doing more business, and increasing your income. I could have just sold Berkshire or possibly liquidated it and made a fast, small profit. But time is the enemy of the bad business. You know, one puff. But sticking with those enterprises is a tremendous mistake. So you might say I learned from it. I would have been much better off doing what I did with Berkshire, which was to keep investing in better companies. I launched the insurance company See's Candy, the Buffalo News, and a variety of other ventures. Instead of utilizing Berkshire as the platform, I would have been far better off doing it with a brand new, small business that I had founded. Even though I've had a lot of fun as a result, everything in life tends to work out for the better. So I can't really complain. It was a stupid thing to do. In 1989, I returned the U.S. Air and purchased a preferred stock. We were fortunate in how things turned out in the end, but it was entirely my fault for making such a stupid decision. And I acquired half interest on a Sinclair, which was my biggest mistake in terms of the event and the opportunity cost of actual costs. Filling station was approximately 20 when I first went there with a National Guardsman, and I had about $10,000 at the time. I put $2,000 in and lost it all. So that was 20%, and the opportunity cost is now $6 billion of that. I actually prefer it when Berkshire goes down because it lowers the cost of that error on an opportunity. A fueling station is a huge price to pay for, getting to wash a few windows and a few windshields and stuff like that. The most of the errors I've committed have been omissions rather than commissions. Actually, the things that hurt the most are the ones I understood how to accomplish and were therefore within my sphere of expertise, while sucking my thumb. And they are the ones that don't appear anywhere. By sucking my thumb, for instance, 20 years ago when Fannie Mae was having issues, and we were about to buy the entire company for basically nothing, I likely cost Berkshire at least $5 billion. I don't care whether it's Microsoft because I don't know that. And I don't have any reason to believe that I should be allowed to profit from Microsoft, cocoa beans, or anything else. But I can't say I understand Fannie Mae blowing it, and it never appears under conventional accounting. The call, however, I know the cost of it. I know I passed it up. And those are the big, major mistakes, and I've had many of them, unless I tell you about them in our annual report, which I sometimes fight the impulse to do. And even when I mention them in the yearly report, you won't be aware of them because they don't appear in traditional accounting. Yet omission is far more significant than commission. We don't do many things, but whenever we have the opportunity to do something important and right, we must take it. Big possibilities in life must be taken, and even doing it on a tiny scale is almost as bad as doing it not at all. In other words, you really need to seize the moment since there won't be 500 fantastic opportunities. You would be better off if you received a punch card with 20 punches when you graduated from this school, and each major financial decision you made cost a punch. You would become extremely wealthy because you would carefully consider each one. For example, imagine attending a cocktail party where someone mentioned a business that he didn't even know what they did and couldn't pronounce the name, but that earned a few dollars last week and another one like it. There is desire to dabble, especially during bull markets, because stocks are so easy. It's easier today than ever. You may do it online by simply clicking the button. If it increases in value, you might become thrilled and purchase a second one. You cannot accumulate wealth over time by doing that. But if you owned a punch card with just 20 punches and knew you wouldn't receive another one for the rest of your life, you would make wise and significant investment decisions and probably would still not use all 20 punches in your lifetime. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.